Hello again, Solis Wealth family. Greg Solis here with the update. Well, family-wise, I don't know about you, but I'm getting excited for the holidays. The fall weather is here. The grass is getting green. The flowers are planted. The weather is so much cooler, and it just speaks football. It talks, Thanksgiving, turkeys, all that kind of fun stuff. So, anyways, excited for that. The whole family is going to be in town for Thanksgiving, so we're really excited about getting into the holidays. So that's what's going on with our family. We're thinking a lot about that. I hope all is well with you and your family as well. Well, market-wise, we've been on continue to be on this tear here. The markets have been running up quite nicely. We've been hitting a lot of new all-time highs, which is great to see. The Fed last week did lower rates, as we had discussed. We anticipated that was going to happen this month in October. That's good news. With the Fed lowering rates, of course, the markets did kind of bump up a little bit. However, when they talked about what they thought might happen in December, they seemed a little bit more hawkish, as we say. Hawkish just simply means that it's not a foregone conclusion that they will reduce rates in December. The market had anticipated 2 rate cuts before the end of the year, but now the Fed's kind of backing off a little bit and saying, they may not do that. So we still anticipate they will reduce rates in December one more time before year end, simply because we see the labor markets really kind of getting a little softer. The labor markets have not been as strong here recently, and that's one of the Fed's mandates, is to keep full employment. And so we don't want to see things swing too far and get where we see too many layoffs and the economy starts to weaken. So we believe that the Fed will most likely lower rates again in December, and then we'll look at 2026 and see what happens. So the market sold off a little bit after the Fed got a little bit more hawkish. It didn't like that kind of talk. It liked the idea of the Fed lowering the rates a little bit more, but nevertheless, it stabilized. But it's still the big story is, again, this Magnificent Seven, these AI stocks that are just kind of cranking along. They estimate that there's about $400 billion that have been spent by the Magnificent Seven in AI. And just, it's an amazing amount of money that's going into this artificial intelligence. And they're anticipating that there might be about a 20% increase in 2026 in that investment into AI. So a lot of money going in there, and the market will continue to watch to see what kind of results they're going to get from their investments into AI. But this has been a theme and a story that we've been talking about for a while, and it's been an incredible drive of the market. So markets have been trading at an all-time high. The bond market's been pretty stable. We still have the 10-year Treasury right at about 4%. So again, if the Fed continues to lower rates and the economy remains pretty strong, we might continue to see this market rally towards the end of the year going into 2026. So far, everything's good. Everything's doing what it should be doing. We've been busy behind the scenes, really doing some tax harvesting before year end. So we've been busy, of course, rebalancing portfolios and doing what we can to try to reduce those capital gains. But it's been a big year. And so we'll be talking more about that as we wrap up the year. But overall, everything's in good order, doing what it should be doing. If there's questions or concerns, we're always here for you. Again, the Client Appreciation Party is coming up here on November 7th. Hope to see you all there. My very best to you. Take care and God bless.